All right, good morning, everyone. It is 7:40 on the morning of February 8th, 2023, and this is my pre-market strategy session. And so today, the title of the video is BTFD. Now I'm waiting for the dip. Um, so yesterday, I wouldn't say I lucked out, but I mean, it just, it's all a matter of probabilities. So the probabilities were in line with me yesterday for my strategy. So yesterday, we got into this overbought situation here, and I'm bullish, and I traded in contrarian to my sentiment. And I really thought that after this big run up right here, and this happens really quite often after Chairman Jerome Powell speaks, you'll see, it's like he steps in the room, he steps to the podium, and it's like, hooray. It even happens during FOMC meetings. Is like, yeah, he's at the podium. That's bullish. That's a good sign. I don't know quite what it is, but it happens really quite often on FOMC days, as well as it seems like every time there's an FOMC meeting and in the minutes, the briefing is released after the FOMC meeting. It seems like there's always another speech that he gives a week later somewhere, like for example the Washington Economic Bureau, whatever that was that he did yesterday. And so he took to the interview at 12:40, and sure enough, there's a run up, and it seems to be always temporary. And it just so happened I put this support and resistance line at 309.62 yesterday. That's the support and resistance level that I'm looking at for the short term. The price popped up right to that and started selling off. And so I bought put options yesterday, just as this thing started to break back down below this 309 level. And I held on to them for too long. I was anticipating a breakdown that would get us back into this area. Even if it was a touch into this area, I was expecting the price action to go back into that area. And this 300.92 is just a short term. There's a gap that happened between, I think it was February 1st and February 2nd. Here, let's go back and look here real quick on the daily chart. Yeah, right here, between the 1st and the 2nd of February, there's, here's the close on the 1st, and then here's the open on the 2nd. And so yesterday I was anticipating price action to come all the way back down to fill that gap right there. And the top of the gap being at 300.92 that's where I was expecting to see the price touch off, at least right there yesterday. And so I got into a great position right here, a great price after that initial run up. It started heading down, and then it started creeping back up again, and then I let go of it probably right about here. It's like I just took profits, and it was a lot less profit than I wanted to take, and it was a lot less profit than I was very, very green on this trade, and then it started popping up, and I was like, okay, fine, I just gotta let it go. I gotta take some profits, Not quite the handsome profits that I was expecting, but profits nonetheless. So and I was using my same old strategy. Both the 1 minute and the 10-minute went into went into overbought at the same time that the VIX was coming out of oversold, and so that's a short setup, and it worked out well, even though my bias is bullish. And even though my bias is bullish, I am waiting for a dip to buy. It's my personal opinion. This is just my personal opinion that we come down and fill this little area of gap that's left. Now, of course, I could be wrong, right? In which case, if I'm wrong and this thing just takes off, if the Qs just take off and keep going, then I've got to wait for the dip. I've got to wait for a dip to buy and then buy again. If we're headed off in the northern direction here, you know, I'll have missed out, and that's the way it goes. There's always another trade right around the corner, and after you've missed out on enough trades, it kind of becomes just part of the game. That feeling of missing out, it sucks. But the feeling of getting into a trade out of fear of missing out and then losing really sucks worse. It's like, I hate to lose more than I love to win, which is a weird thing to say, because I love to win, but my hatred for losing is greater than my love of winning. Like, I don't know, it's the way it is for me. So next dip, if this thing doesn't come back and backfill to this area, roughly 300, roughly 300.92 is the exact number on the screen, but I think we'll dip a little bit lower. I am still expecting, there's the tiniest bit of gap left now, since the markets did pull back after this gap up. Between the 1st and 2nd of February, there's just the tiniest bit, maybe just a little bit more than $1, which isn't a heck of a lot. It could be close enough. It could be close enough to be called filled. But anyway, so I'm waiting for the dip either way. I am bullish, and so I am waiting for either price to come back down here to this gap and move away, or I'm waiting for price to go ahead and pop through, and then come back down, retest, and move away. And the retest actually doesn't have to be right at 300.9. It just, all it has to do is pop up a couple more percentage points, pull back, and then look for sort of the recocking of the gun for the next move higher. There, to kind of put in context too, there has been over a 20% run from the low on Wednesday, December the 8th, to the high on Thursday, the 2nd of February. It's been a 20.77% run, which is a good year on the S&P or the Qs. 20% gain in 1 year. That's fantastic. If there's anybody that bought down here at the bottom and managed to get the whole chunk of this run right here, good for you. Nice work. If you did that, leave a comment below. Either way, I'm waiting for a dip, whether we get a dip to this 300 area or break out and then get a dip to just kind of, take a pause and then the next leg higher. That's where I am for the time being. VIX, I like to use this 19.12 level on the VIX to kind of gauge whether we're going to keep heading down, which way we're going to go in the day. And as of right now, the VIX is opening below that 19.12. That's a good sign. And there's really, outside of the 10-year, 2-year inversion, there's really nothing to fear. There are also, I'm going to open up another window for this so that it doesn't mess up my other windows here. Let me go to my indicators, and you can see there is PMI happening here. Here's the Chicago. This is the U.S. United States. Okay, this is the U.S. one. Where's the Chicago? Yeah, here's the Chicago PMI. So the PMIs are below 50 on both the U.S. and the Chicago metrics, and that is a sign of a contracting economy. And it's forecast that we will be in a contracting economy until the second half of the year. These dismal signs, these dismal economic signs are forecast to continue. And so into the future, and also just sort of the previous yield curve inversions, that chart back the data is available for through this charting system, goes back to the 80s here. And the the inversion can occur. The markets can, the inversion, the yield curve can be inverted, and the markets can still be bullish. In fact, these blue lines denote the top of each market, whether it's the Qs or the S&P. They're very, very similar. And you can see that this is the date. Sorry, this is the date that they crashed. The tops came in like a month or two before sort of the crash dates, right? And in this whole time leading up to the crash date, practically the whole time, the markets were still bullish. The Qs and the S&P were still bullish. And so that's where we could be right here. I mean, and this lasts for 8 to 12, or I'm sorry, from 12 to 16, 18 months, 12 months to 18 months. That's how long, this thing could stay inverted before we actually see this thing start to, come back up and normalize. And so even though, we've got this crazy inversion and we've got these crazy contracting PMIs, these PMIs are really low. Like, for example, this reading back here for November was 37.2 on the Chicago PMI. And I mean, that is only, that's as low as it was in 2008 for the housing bubble, as low as it was for the 2020 COVID crisis, and then the .com bubble back here was at, let's see, 41.40. I mean, so we went lower than the .com bubble, with this 37.2 reading. I mean, so the storm is on the horizon. Whatever this is, whatever is going to work its way forward to the markets, it's out there. It's just in the meantime, what do you do? I mean, you set up short positions for something that could be, 4 months to 10 months away. Now, I mean, you could experience a lot of pain if you're on the short side of something that keeps rising for the next, say, 3 or 4 months. If it ends up being a year-long yield curve inversion. This could end up being an 18-month yield curve inversion, or even go longer than that, 24-month yield curve inversion. And I don't know anybody who can stomach, 24 months on the wrong side of a trade, or on even the wrong side of a position, for that matter. I think Dr. Michael Burry was on the wrong side for a very long time. I read the book Moneyball, and oh gosh, what was the Big Short? Yeah, I've read his Liar's Poker, Moneyball, The Big Short, and another one too, I've forgotten. And they're all centered around essentially the same thing, which is statistical probabilities, and so in how it relates to everything from baseball to markets. And so here we are, in the meantime, I'm going to be bullish. In the meantime, I'm going to, do what the chart tells me to do. And right now, the equity markets are telling me to be bullish and to BTFD, just wait for the dip. So I'm going to be waiting for a dip. I'm waiting for an opportunity to buy. I'd love to see prices get down in between this 300 and 294 area. For a nice big juicy pullback to buy into. At this point, I doubt I'll get it, but I'm not going to fear missing out. If we get a big pop-up run right here, I'm not going to fear missing out on that run. I will get the action. It will happen for me. I just have to wait for the dip. That's where I am. That's what's going on. Of course, if my charts line up, if I get my 1 minute and my 10 minute lining up where it goes into oversold on both the 1 minute and the 10 minute, and actually, pre-market here, we're going into oversold on the 1 minute for the Qs. And it's starting to creep downward for the Qs on the 10 minute. But if all four of those charts line up, if all four of those relative strength indexes line up between the Qs and the VIX, I'll jump into a position. I'll jump into a trade. If my signal isn't down into, or if the signal doesn't occur down in this area where I really want it to occur, I'll still take it, but it won't be if it happens, suppose I get my signals right down here, like somewhere like around 302 or something like that, I'll take the trade. But I'd really like to see the signals happen down here in this area for a much longer trade, a much longer, more profitable trade. But I will take my short-term opportunities like I did yesterday in overbought conditions, like right here. And it did coincide with the resistance that I had up yesterday. All right, everybody. Yeah, that's pretty much it. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell. Thanks for tuning in. I will see you at tomorrow morning's strategy session. I am out.